I'm Eric Chemi, and this is Politely Pushy. Rob Enderle joins us on the podcast today. Rob, you have done so much in the world of technology, business, as an analyst, as a thought leader, journalist. You've done so much. There's a lot to get into, but I just want to start with, what is the game these days? When you think of the big analyst companies, the Gartners, the Forresters, what do you think of them right now? Because a lot of people are afraid, hey, this is a lot of pay for play. How much of them should I really be trusting?
Well, it really depends on the relationship you have with the analyst. The analyst is the one that's providing the underlying service, and so it depends on the quality of the analyst. And if you're talking about the big firms, that quality can vary a lot. They've got some fantastic analysts there, and then the firms tend to go through these periods where they figure they can hire a warm body and pay them next to nothing and call them an analyst, and off they go. And that's not the greatest service. So depending on the analyst you're engaged with, will directly dictate the level of experience that you're going to have. Also recognize with the larger firms, they are distracted by the amount of money that people are paying. So the more you invest in them, the more attention you'll get from them. That means as a small firm, your ability to get value is substantially reduced, at least with regard to visibility. Is substantially reduced with a larger firm, because you're a small fish in a fairly big pond dominated by sharks. So the magic quadrant stuff and that kind of play, it just recognize that the folks that are rated at the top, they pay a substantial sum to be rated there.
The magic quadrant, to me, I always remember it from every time I close a Zoom window. They have that pop up and they always say Zoom is one of the great, I think it's the magic quadrant that they show, but that's always ingrained in my memory.
Yeah, it means something to the vendors. It means less and less to the buyers. In fact, much of what's happened with the big firms is it's kind of they feed the people that pay them, and they feed them fairly well, and the vendors really are the ones that contribute to the bonuses, the profit margins. So the vendors have a lot of sway in the bigger firms these days, and that's kind of the way the game is played.
But talk about in real numbers, when you say a big budget versus a small budget, what are the kinds of numbers we're talking about? In the thousands, the millions, the tens of millions?
That's really you get to seven figures, you've got their attention. Below that, it's much harder to get interest. I mean, recognize you're competing for attention with multinationals, and multinationals can afford to buy a substantial amount of services, and the vendors will make sure that those multinationals get the attention and the rankings that they deserve, because they don't want to take the revenue hit if the multinational gets upset and pulls out.
You mentioned being number one in the past, and you're not trying to be number one now. Who's voting on these rankings? How is it made? Is it a real political game?
There were firms that ranked the analysts. Most of them, to my knowledge, went away about a decade ago. But while they were ranking us, I was ranked number one in influence. And I'm well aware that I'm not at that level anymore. The maintaining a number one ranking is a substantial amount of work, and I was outranking firms. So the amount of effort that was put in to maintain that kind of ranking was significant. And I was not only number one in the U.S., I was number one in Europe, and I was in the top 10 in Asia. It required an awful lot of late night support. In fact, when I was back working at Giga, one of my peers tried to cover for me when I was on vacation. He lasted a day. He just couldn't take the load. So it does take a particular skill set. I mean, I was trained in media. I was supposed to be an anchor for a new TV show that sadly was canceled right as I finished my training. But I've done a number of TV shows since. And a number of radio programs as well. So it's been a fun run.
Let's talk about this. So what was the show you were about to anchor, and when was this, and what channel? I want to hear about this.
Well, the show's about to anchor was an internal IBM news program. Back then, in the early 1990s, IBM had its own internal news program that was broadcast all over the company. The TVs were in all common areas. and you were expected to go in and watch the TV program, and they trained the anchors to go in there, and we received formal studio anchor training. And so I came out with that, but as I finished, IBM realized there was really nobody watching that program, they discontinued it. We had a syndicated show that remained in syndication up through around 2010. That was a lot of fun, and then I also did morning news for the local station. I had a 7 a.m. spot daily on the news, which kind of screwed up my entire day because you had to be really on at 7 a.m. and then by about 2 o'clock in the afternoon, I would just fade completely out. But that was fun too for a while. I did that up through the early 2000s.
What does it take to be number one? When you said someone filled in for you, they didn't last a day. You were top 10 in Asia, number one. What are you doing?
Yeah, you're answering questions, going on TV, radio, print. You are the analyst of last. I was the analyst of last resort for every news service. I was top rated across the board. It was funny for some of the magazines. I get called. And I was actually blacklisted in one of the magazines because on one publication there were a lot of analyst quotes throughout the magazine, and I was the only analyst quoted. So that was when they said, okay, no, first person that gets him. You other folks have to go find somebody else. You can't do an entire publication of quoting one analyst on literally every subject you're talking about. But that was the nature. You had to be conversant on everything: personal technology, servers, storage, security, e-commerce. But the thing is I've always been kind of a jack of all trades. My mentor at IBM said that the only way I was going to succeed is if I specialized, and I've spent most of my life proving her wrong. So I really kind of enjoy the breadth of a generalist, and that allows me to move to whatever is topical and interesting. And it also assures that I don't really age out, because like specialists, if you're in a specialty area, sometimes those specialty areas go away. I mean, imagine a specialist is covering fax machines or something; they're done.
Right.
And this way, I can remain relevant because I'm always pivoting to whatever's interesting and topical. So it allowed me to maintain a lot of breadth. And while I was at Giga, I managed e-commerce, security, desktops, servers for a while. You name it, I had it. So it provided a lot of breadth. And I was part of the executive training program. Executive Resources is what it was called on IBM, which was supposedly supposed to train you to be CEO, but the chance of that ever happening was less than slim or none. But it did give you a lot of breadth, and it did teach me. I never really wanted to be a CEO of a multinational corporation. It's something that looks really good from the outside, but once you learn what the job entails, it doesn't sound like fun at all. You get a lot of status, but geez, the stress, the pressure, if you're going to do the job right, is high. And a lot of CEOs fail because they just focus, they massive salaries, they focus on the perks, and they delegate all the rest of the stuff. And you can't do that and be successful. You really have to take an interest in your people and in your sales and your financial performance and in your manufacturing. You have to stay up on all that stuff if you want to be good at it. And I'm a bit OCD that way. I tend to be very, very focused on everything that I'm doing, and I realized that job would kill me. It just really would. I wouldn't last more than a few years. I'd either burn out or I'd die. So stayed away from that career path, but I learned a lot.
That's quite the story. I agree with you. I think that's what's involved. You do wonder, they're paying a lot of money to these CEOs because nobody would do it for free, right? The job is actually a bad job.
Yeah, and the thing is when you take a job like that, which is really, it's more breadth than a human being can handle. So they're spread thin already, and then you give them a lot of money, and and that money then buys a lot of stuff, and now they're spending a lot more time managing that stuff that they bought. So not only do they start off not having any personal time, they just bought a bunch of crap that just took away whatever other personal time they had. I mean, they're at the deficit already, and they've now shoveled in much more deficit and made them more interested in the stuff that they bought and owned than the stuff that they're supposed to be doing. And then you can kind of explain real quick why the majority of CEOs fail in the job. They're structured to fail. Not to mention the fact that I was the exception in terms of being trained as a CEO. Your CEO training, which is supposed to be that MBA program, which I've been through, doesn't really prepare you for being a CEO at all. So that lack of focus training in the job, coupled with the distraction, I mean, it's almost like they designed the job to cause CEOs to fail. And the successful ones, I mean, the truly successful ones, take and put all that stuff aside. Just figured they'll deal with it when they retire and just focus on the job, and they'll do well. Often that's why a founder does better than a hired CEO, because the company is theirs. And so it has the higher priority over the other stuff that might distract them. And it's that caring that makes the difference.
What do you think about someone like Elon Musk, right? Because he's both a founder and a hired CEO, depending on which one of many companies he's involved with. And talk about being spread thin on one company and talk about having a bunch of money. He's got so much money, he can go buy himself other companies, let alone a second house.
Yeah, well, or no house. Right now, he's houseless. He's one of the homeless.
He has more companies than homes.
He lives in his jet and 47 Teslas. But Elon Musk is a disaster waiting to happen. He is spread way too thin. He is very impulsive and can't be controlled. So you combine massive amount of power and reach with a bunch of companies that are all running on the ragged edge, and a guy that has no impulse control. I mean, I'm just glad I'm not in any of those companies, because you're just waiting for the explosion. This Twitter thing was an avoidable train wreck with no real purpose. He's tanked Tesla stock. And his buying audience is largely liberal. And he just upset the entire group. So it's quite literally like watching somebody run with scissors. And really not have full knowledge of what they're doing, and not really caring what the outcome is going to be. It's the damnedest thing I've ever seen. I'm just glad we're watching it from a distance.
But what's interesting is you could have said that about him.
He could bring down a whole chunk of the tech market.
You could have said that about him in the past. Like, your description of him is the same, and
he's
the richest person in the world, right?
Not right now. He's not. The drop in Tesla took him right. I think they said like $63 billion down. I mean, he took a hit. And yeah, you're right. He's potentially very wealthy. And arguably successful. But when you're taking this kind of risk, where none of your companies are really on solid ground at the moment, and where what you do could create a cascade where all of them could fail at once, you kind of would hope he just kind of focused on keeping those companies from that particular outcome. He doesn't exactly have the time to go to war with Twitter right now. I mean, just running Tesla is more than a full-time job. Trying to run all these other companies, it's much like he's just trying to see how much he can do before it all explodes. I mean, back into it, he has no house. It's not like everything goes under, he's going to be homeless. He's already homeless. It's just the people that are investing in him probably do have homes and retirement funds and stuff that they really care about and preserve, and they don't have the liquid cash resources that Musk has to survive the downturn. Anyway, it's just I'm glad to watch him from a distance, and I'm so glad I'm not responsible for trying to keep him out of trouble.
What about, it's funny sticking to Twitter, because the other person that had multiple jobs, think about Jack Dorsey, Twitter and Square, right? If one CEO job's hard enough, here's two.
And that's kind of why he had to step down from Twitter, right? He had to focus on one of the two properties, and he made his choice. Both of those efforts, and I would argue Twitter by itself is because it's in transition, would be enough work to keep any reasonable person more than busy for the entire time they're doing the job. So Dorsey was smart. There's that old Clint Eastwood saying that you've got to know your limitations. You just need to recognize that you're only human. You can't work 24/7. And keep all these balls in the air. I mean, you can be lucky, and Musk is incredibly lucky, and he's kept those balls in the air for a surprising amount of time. But it's like super cold water. Have you ever seen super cold water? Super cold water remains liquid, but all it takes is an instant, just a tap, and boom, you've got ice. And that means you can't recover. If things will cascade so quickly the way he's got this set up, there's no way he's going to recover this if he drops into a cascade. If a lot of people, and we may be seeing it happen right now, what I'm hearing anecdotally is a lot of people have canceled Tesla orders, and the only saving grace is most of the competing electric cars, well, that are mature and really interesting don't show up to 2025. So the good news is the heavy competition is still a couple years off. The bad news is the competition is ramping right now, and it's not like everybody needs to buy a car at the moment. And of course, car prices are going up rather dramatically, which may mean his big problem may not be competing cars. Maybe people just saying, I just keep what I've got because I don't want to pay, 20, 30, or 40% over to buy a new car.
Right. Thinking about cascades that move quickly, NFTs, Bitcoin, crypto, these have all imploded over the last few weeks. In the time between when we said, hey, let's do this podcast and actually record the podcast, like boom, there goes 90%.
Yeah, I've warned about crypto and NFTs for a while. This goes all the way back to the flower problem back in years ago. Can't think of the name of the flower, but the
tulips in Dutch tulips.
The tulip problem is blanking on tulips. But the tulip, people get real excited about something and then they bid the hell out of it up. But if there's nothing underneath it, then you're going to get a collapse. It's not a matter of if, it's a matter of when. And so if you're real savvy, you can get in the beginning and ride it, but you've got to get out before the collapse. And the timing of that is kind of when people realize they've got a problem, and it can happen very fast. It really lends itself to somebody that has some type of an electronic trading engine, because you've got to trigger quickly when the trend initially becomes evident. Otherwise, you'll lose everything that you made. One of the guys who was over visiting me yesterday said he was just so happy that he sold and he broke even on crypto. And that's kind of the way it is. It's very speculative. It's very high risk. It's basically a Ponzi scheme, and so you want to get out before the incoming buyers recognize that it really there's nothing there, and so they stop coming in and bidding the property up, and then it collapses, and that's what we saw. So there's nothing underneath NFTs or nothing underneath crypto. They can go to zero. There's nothing that prevents that. There's no federal government insurance or assurance or control, no oversight or management to a degree that would prevent this kind of an outcome. And as a result, the only people that should be investing in these properties are people that really understand the risk and have the money to risk. This is certainly not something that you want to put your retirement fund in. And I'm well aware of the fact that a whole bunch of people just lost their retirement because they got overinvested and thinking that they were rich, and now they aren't. I mean, remember the .com collapse? There are a lot of people running around thinking, I'm a millionaire, multimillionaire in paper, and then it collapsed, and suddenly they're underwater in all their options, and they leverage those options to buy cars and houses, and suddenly you had an awful lot of people living in brand new BMWs running around Silicon Valley, and that wasn't a good time. We're in that kind of an event again now, and it's problematic.
I mean, I put a little bit into crypto, but it was like a little bit, right? Like, we knew that if this goes to zero, we're okay. It was just a little play money, but not.
$100, $1,000, something just like anything. It's like going to Las Vegas. Don't bet anything you can't afford to lose.
What do they say? Don't bet the farm.
Yeah, we don't bet your house or your farm. I mean, anything that you need, you don't involve in an investment like that. You could make a lot of money, but you also have to set and be aware. If you're doing something like this, set a threshold. So, okay, if it doubles, I'll sell. How you assure you always lose is you don't set a threshold, because that will mean because it will always correct. And same thing with gambling. If you haven't said at this point I'll get out, you will always lose. You have to set a threshold where you will get out, or the odds turn against you almost 100%.
Something where the odds have turned down for a lot of companies. You're seeing a lot of tech hiring freezes, layoffs, Amazon warehouse cutbacks, IPOs are disappearing, SPACs are going to zero. Do you see any bright sides here? Do you see it's overdone? Is there any part of the sector that is actually going to be okay?
Well, I mean, certain things are going to continue. I mean, they're doing layoffs, but it's not like these companies are going under. They remain profitable. it just, now we're dropping into what looks like a recession. And now you need to do recession planning, and that means you need to rationalize your labor. You probably don't want to hire a whole bunch of people right now because you may have to turn right around and lay them off. And if you were if you were thinking that your job was really secure and you can say whatever you want to your manager, yeah, you might want to change your behavior because you might want to hang on to that job for a while. The days of people being able to call their own shots with regard to jobs may be evaporating pretty
Those
quick.
days were like 3 months ago. Remember, it was, I can work from anywhere. F you, I'm out of here.
That's exactly right. So that those rules are in the process of changing. For some people, they still exist because they're, for instance, if you're a data scientist, you're still pretty much golden. But for a lot of us, for a lot of people that are out there, those days are over. And if they don't realize it, they're in trouble. And people selling houses, there are folks out there, oh, I'm going to sell my house for 3 times over. Hey, if you get an offer that's 50% over and it's a profit and you want to sell, take it and run, because 3 months from now your offers could come in below what you paid for your home. Because the interest rate's going to continue to go up, the inflation's going to continue to go up, and people are just going to have a lot less spendable money. So the world the way it existed up until this month, for the most part, isn't going to be existing for the rest of the year, and so you need to adjust your buying and selling behavior accordingly. The big investment houses are kind of saying, right now it's time to hold on to your cash because if a lot of these markets collapse, that's when you're going to want to go in and buy. But you don't want to buy during the downturn. You want to buy close to bottom. You don't want to ride this down. You want to benefit from the collapse, and making that call then becomes your interesting bet.
How are you invested right now then?
Oh, I don't, because of the nature of my job, I don't touch any of my investments. It's all programmatic. Because I talk about public companies, industry analysts don't carry the requirement that stock analysts have, but I operate under the abundance of caution. It's because the level of my influence was so high and remains reasonably high to this day. The concern that I might be accused of manipulating stock was just too great, and so I have no idea where my investments are, and just because that keeps me clear of any accusations with regard to doing anything improper.
So one day you'll retire.
I was an internal auditor for a while, so I'm really careful about this stuff.
One day you'll retire, and it'll be like, here's what you're left with. It's like, this is what you got.
I know how much you're in the funds. Don't get me wrong. I do keep an eye on that, but in terms of what the funds are made up of, that I don't know.
Let's talk about some questions that some CMOs and CEOs that I talked to before this, they wanted to know, they wanted to ask you. They said, so what works in analyst relations? If I'm at a company, let's say smaller, mid-size, I want to break through, what works? What mistakes do companies make when they're talking to you?
Well, and this is true of anything. We at Giga, we actually had a course and not only how to do presentations, we taught people how to a certain extent, we try to teach people how to deal with analysts. The thing is analysts are people. You treat them like people, they'll treat you decently. If you don't treat them like people, expect something less than positive to come out of the relationship. And that means you've got to get to know us. This is not something where you throw money over the fence and you hope something magical comes back. Each one of us has certain strengths and weaknesses. We're all different. We all came from different aspects of the industry. And if you don't know any of that stuff, you don't know what we're capable of. And you can't judge our advice with regard to how good it is unless you know that background. For instance, I once was asked whether Katie Couric's TV show on CBS was going to be successful. And I provided an answer, but that was not anywhere close to a skill level that I was involved with, and I probably should have been asked in the first place. So knowing what the analyst's strengths and weaknesses are, knowing what it is they like and dislike, those are things that allow you to engage with the analyst on a personal and professional level, and have the engagement be very productive. But if you don't understand where the analyst's strengths and interests are, if you don't understand what they like and dislike, then every engagement, every conversation, you're walking into a potential battleground where you might say the wrong thing, do the wrong thing, and suddenly, especially if you're like one of the larger firms, they'll nod and smile, and then you'll see the research note, and they're just all over your product and not in a positive way. And suddenly you're wondering if you're going to have a new job, because management does not appreciate an AR department that turns an analyst against the company. It's not a career adding opportunity. But if you know and engage properly, you can do it. And some analysts are, well, to put use a weighted term, are assholes, and knowing that as well says that maybe those are the analysts you don't deal with. There are some analysts that are just kind of famous for being jerks, and those analysts you want to maintain, because it's always going to end badly. It's going to end badly eventually, so you just let it end badly on somebody else.
What's the business model though for an analyst? If it's, I'm getting paid, so let's say you're the analyst, you're getting paid, but you still write a negative report, or people know that you're an a-hole. How does that business model work then? It's like, I take money, I write something bad, and now everyone knows I'm a bad guy. Like, then you're not going to stay in business for too long.
Well, it depends. So the smart company recognizes that if the analyst is being honest and sincere, in other words, if they're not acting vindictively and making stuff up to do damage, which does happen in the industry, that they're being honest, then they value the honest feedback. The trick here is to try to get that negative feedback outside of media. So you know where they're negative, and then you can work on providing or fixing the underlying problems before they go to press. I remember one of my first interactions as an analyst was with IBM, and I'd been with IBM for a decade and left, and then went to work for DataQuest. And one of the first reports I did was an operating system forecast, and in that forecast I said OS2, which is IBM's premier product, was dead. They were not happy, and in fact I called them up ahead of time and said, listen, I was with you guys, but I'm saying OS2 is dead, and here's the reason I'm saying it's dead, because I know you pulled the budget on it, and you broadcast outside you pulled the budget on it, but with no budget you can't compete with Microsoft, who's dropping hundreds of millions of dollars in their product, and you're doing zip-de-doo-dah. So it's going to be dead. And the AR person said, well, don't worry your pretty little head. Sarah, this almost word for word. Don't worry your pretty little head about it, Rob. Nobody's ever heard of you before. Nobody's ever going to read your report. I said, well, just make sure you tell your management that I'm doing this so they're not blindsided. Yeah, I'm not going to do that. They're not going to see it. Nobody's going to see it. Issued the report, front page business section, Wall Street Journal, front page of most of the major newspapers all over the world. Next call I got was, you're never going to work in this business ever again. We are going to drive you out of the industry. And you can see how well that worked. And it was kind of slow. And the most amazing thing is they called me up to Armonk to yell at me, and the two AR people yelled at me, and every engineer in the room said, no, he's right, you're wrong. And it was the most astounding thing I ever sat through. But those analyst folks AR people were gone after that. And that can showcase just how bad and ornery it can be. That was a 1 year event where I went from unknown to the most influential analyst in the world in 12 months, only because I rode the Windows 95 launch, said it was going to be successful, and pretty much forecast the death of OS2, the downturn of Unix. Linux wasn't a thing yet, and even the decline of Apple. And the only thing I screwed up on the Apple thing was Steve Jobs hadn't come back yet. That was 4 years before he'd returned. And had he not come back, there's no doubt in my mind Apple would have gone under.
Right. I think that's a fair assessment.
Yeah.
So
you only forecast based on what it is on evidence.
It's like my forecast.
There's no chance that Steve was ever going to come back. I mean, he was bad mouthing the company all over the place. So who would have thought?
Yeah. Yes. I think that's a fair miss. A lot of companies, they are trying to say, hey, we're differentiated. We're not like the competition. We're different. We're better. A lot of them are not differentiated, but they need to come up with a way of saying it. How do you know if a company is differentiated, and how do they figure out some kind of differentiation if in reality they're not?
Well, you just do doing a SWOT analysis or competitive comparison was part of what I did when I was in competitive analysis, and I'm reasonably good at it. But most of the analysts are good at doing comparatives. I mean, it's part of what you do as your job. And so when a vendor comes in and says they're unique and they're not, they immediately lose all credibility. And that will just, I mean, whatever you're doing with that analyst, you can just throw it out at that point. If you come out and say things the analyst knows is untrue, then it doesn't matter it doesn't matter how good your product is, the analyst isn't going to believe or trust you. And that trust aspect is critical to the relationship. If you lose an analyst's trust, you've got a problem, because it's going to be really hard to get that back. It's somewhat easy to gain an analyst's trust, but it's really hard to regain it once you've lost it. Almost impossible. We tend to be fixed, focused types of people, and once a vendor does something that is that unethical, then it can be very hard to recover from that event.
You mentioned in the beginning how you're a generalist, right? And you mentioned a lot of different product categories. When do you create a new product category? When is it ready to be, okay, this is a thing? Think about in the 90s, the cloud wasn't a thing. Mobile phones wasn't a thing. Right? These things have all been made since then. When does that happen? And what are the pros and cons?
More than one vendor in it. You don't have a category until you have more than one vendor, and so you need multiple vendors, and somebody's got to be at critical mass. I mean, the thing is so is there a category for pet rocks? Well, not anymore. And there really wasn't one at the beginning. There was one company that did pet rocks. It went up and down. They're gone. So it wasn't so much a category as it was kind of a scam. But you need two vendors, and at least one of them has to be a critical mass. So they've got to be doing something that is raised to a level of performance that makes this a real market and not a transitory market. Now, sometimes, like say 3D TVs, that was a category, not anymore. Although for the most part, you can't even find a 3D TV in the market. It's an old one. So the categories can come and go. Fax machines were a category. Interface programs to go with the CompuServe and AOL were a thing, but the internet took those out. And in fact, there's an example of a product called Crosstalk that existed back then that was so dominant that nobody could compete with it. And the internet came and they were gone. I mean, they went from being massively dominant and to being off on an eddy someplace that nobody else wanted to be. So these segments can change very rapidly. Generally, from my perspective, I'm not in the habit of naming segments. I let other people do that. And then I fit stuff within the segment that's already named. I don't, at least right now, I don't create segments. I might name products where they haven't been named properly, because that was a lesson I apparently didn't learn well enough when I was in IBM doing naming. But I try not to name categories.
What about companies that are the only one, right? You said you need two, but a lot of companies that say, hey, we are the only company that does XYZ. We've created a new category. We hear this a lot.
It's not a category. So until you've got more than one person in it, it's a unique product that may or may not have a play in the market, but it's not a category until you've got more than one person in it. It's just a product. And typically, when somebody comes out and says, I've got a brand new product, a new product area that nobody else is in, they're in a product area. They just haven't quite figured out what product area they're in. And let's give you an example of common mistake. This is a textbook mistake. Is talking about buggy manufacturers thinking they were in the buggy business when instead they were in the personal transportation business, so they didn't get in automobiles and they went out of business. That's textbook. So the category should anticipate where the technology is going and talk about its purpose. It shouldn't be related to the product. In other words, there should never be a buggy product category. There's a personal transportation category that buggies are in. So are motorcycles, cars, trucks, whatever. But that's the category. And it falls underneath the master category of transportation. So the category should be defined by the product's purpose, what problem it solved, not by what the product is.
Right.
And once you do that, you can collapse a lot of these guys that say that they are unique.
Because when you say fax machines, all of a sudden it's like, well, is the fax machine any different than the mail, email, phone calls, text?
Communications product. It's in the communications class. Electronic communications, if you want to do a subcategory, and of course it was taken out by email. So which is another product in that same class. So fax machine was unique. But it was in a class where the dominant product now is something very different, and fax machine makers didn't pivot for the most part. I mean, some of them are in printing, but they didn't see communications as a thing, and printing is publishing, and electronic publishing is now dominant. So you figure if you're in the printing business, you're actually in the publishing business, and if you were hedging, you better be doing electronic publishing, or you're in trouble. We see that playing out between the print manufacturers and say Amazon, who with Kindles and Fire tablets is kind of moved away from paper and printers, and they're delivering a impressive amount of content electronically, and there isn't a single printer maker that's playing in there, and so they're kind of waiting for that fax machine event. I mean, some of them are doing incredibly good work holding it off, but they're not thinking through their segment.
Thinking about some trends, I'm thinking about privacy as a trend. We saw the Twitter agreement, the $150 million payment to the FTC as a fine for what they were using with phone numbers and emails and all of that. Is privacy going to be a bigger trend for consumers? DuckDuckGo as a browser, Proton Mail. It seems like it's more of a niche edge thing, but people aren't giving up their typical Gmails and iPhones and Androids.
So privacy is a funny thing. We did surveys on it towards the end of the last century, and actually in the beginning of this century, and
20 years ago.
About 20 years ago. And what we found was at that time, the younger the audience, the less concerned with privacy they were. The older the audience, the more concerned the privacy is. And that's, of course, that's a moving bar. But I think it's consistent. Most young folks think that, hey, as long as you're giving me good service and you're not using information against me, I don't really care. And older folks say, I don't trust anything that you're doing, so I'm going to keep all my information close, and I don't want you to have it. They're the folks that tend to get really upset when something goes sideways. But kids don't really like the information to be used against them. But if you're using it to provide them with better products and better experience, that kind of thing, they're good. If you're using it to lie to them, to manipulate them, not so much. Though I have to point out that it's relatively hard to. The manipulation is getting pretty good. It's relatively hard to catch it. The election in 2016 is that case in point. The massive number of people that were manipulated in that election was unprecedented through social media, and yet instead of a big massive blowback on social media, particularly given the damage that was done, folks are still just going right along using the stuff and almost as if nothing happened. So it's fascinating to watch this segment.
When you talk about the moving bar, so I think about, look, I'm 38. 20 years ago, I was 18. So are you saying it's literally the 18-year-old then 20 years ago didn't care about privacy? He becomes me at 38, or let's say 58 in 20 years, and he cares more. Like that same person will care more over the life of the time.
As you get older, you tend to get more conservative, and so your liberal tendencies are when you're young, your conservative tendencies are, and we get and we know that the way your brain develops, it's much more flexible when you're younger. You're able to handle change better. You can be much more progressive, and as you get older, you kind of want stuff to stay the same. You realize there's too many things to remember. I know how to do it. Why would I want to change it? It's part of aging, and that aging process tends to move people from one camp to another. Not entirely. I mean, clearly we've got liberal older folks as we have conservative younger folks, but the age does seem to have a major impact on how you approach the world around you and how tolerant you are of change and the speed of change. We're moving into a time. If we thought the last 20 years had a lot of change, we're moving into a period of time where change is going to be coming far more quickly than we've ever seen it before. I mean,
what's the next trend?
Well, we've been talking about flying cars and self-driving cars since the 1920s. We're finally getting them now. Autonomous robotics. I still think the big game changer is artificial intelligence, because it's going to change how we work, when we work. At Microsoft Build this last week, they were talking about AIs coming in and working in concert with you as a peer while you're programming and finishing your code, suggesting code to you, and doing about 30% of the coding itself. And this is just the beginning. In 10 years, it'll be 60, 70% of the coding will be done by computers. And that's just one industry. If you look at factories and the level of automation that's being applied on those factories, it's amazing. And look at Amazon warehouses. The downside to all those unionization efforts is undoubtedly going to be new warehouses going in that are 100% automated. I mean, you don't have a unionization problem if you don't have employees. So the pandemic is driving fast food restaurants to put in high levels of automation because they can't get people to work in them. And the robot, as expensive as it is still better than not being able to open your restaurant. I mean, the other weekend here, both Taco Bells were closed down because there were no staff.
Yeah, I think you're on a lot of points there, right? If people aren't going to work, companies are going to have no choice but to push it to AI, push it to robotics, push it to software. It'll go back to capital versus labor, and then they won't need to hire people. It's like we're all set here.
Exactly right. We're right now. A bunch of companies are fighting for automation to be used to enhance people. IBM, Microsoft, probably two of the companies that are leading that fight in that regard. But the pandemic and worker behavior is driving a counterpoint. Maybe we need to go to full automation and just get rid of the people. The economic impact of that kind of a move, if it happens on a large scale, is going to be devastating. Because who's going to buy the products if nobody's working to earn the money? But fortunately, that's something that will probably not occur for another 20, 30 years. But we are heading towards a period of time where that could be problematic. And I don't like the trends that I'm seeing at all here.
Really?
Well, this trend of full replacement as opposed to assist, which the pandemic appears to have triggered, that's problematic. If you start displacing large numbers of workers, you're going to have huge socioeconomic problems.
There's so much more we could talk about, but I feel like that would be a separate podcast. At least for now, though, I don't think the AI and the robotics can replace tech industry vendors and tech industry analysts like yourself. Right. So you're still out there. Rob, this has been a fascinating conversation. I really appreciate the time today.
I enjoyed it myself. Anytime.
Thank you. Thank you to my guest, and thanks for listening. Subscribe to get the latest episodes each week, and we'll see you next time.